about 10 days ago, Baoshang Bank in Inner Mongolia was actually allowed, the Chinese actually allowed for it to be publicly announced that the PBOC and other Chinese bank regulators and insurance regulators had taken over the bank. And while a lot of my listeners were skeptical that it was a small bank, it claimed on its website it only had $20 billion worth of assets. There were other estimates saying that it had $50 billion worth of assets. We just got potentially the next domino to fall. Remember, I said for those who are skeptical, we should wait because remember what happened during the U.S. financial crisis, past European banking crises, that all we had to do was wait and see if there were other banks that would have trouble, if there would be counterparty risk, if the banks would stop trusting each other, if things like the London Interbank Operating Rate, or LIBOR, in this case in China, I guess it's CHIBOR, if that would start to spike and the banks would stop to trust each other in China and there would be big counterparty risk. Well, today it looks like the second domino just fell. So this bank is a lot larger in terms of assets than Baoshang Bank. This bank and Baoshang Bank, according to this chart I'm seeing from Barclays Research, says that Baoshang Bank had a lot larger assets than the initial estimates. But this other bank has around $105 billion in assets. This is the Bank of Jinzhou, a city commercial bank in Liaoning province, the second name on the list above. So it has 723 RMB billion, or yuan, billions of yuan in total assets. Only Hongfeng Bank has more. So this is the second largest regional bank, whereas Baoshang Bank was only the fourth largest. The charts here in the article. So it talks about, basically in this article, how now it's starting to be counterparty risk, and this is going to start to snowball, unfortunately. And we see this with European bank stocks. We see the charts on the European bank stocks. There's an index chart of the 7 largest European bank stocks, and it's absolutely horrible. I have it in the Wall Street for Main Street Facebook group, and we're going to have to see what the Chinese decide to do here, what type of bailout. They already assumed the assets of Baoshang Bank, but this hasn't stemmed the tide because we just got news of another bank. So my educated guess, because I've seen this play out in the U.S., and in general, I don't trust bankers at this point. I don't think anyone should. But, the bankers pretty much try to do the same game plan. If they can get away with it, not go to prison, they will leverage up. And the assets, when these banks have a lot of assets, normally they're holding the assets on way, way too much leverage. It's just really sad. Got some more news out of Europe as well. Jeff Gundlach gave an interview recently, and he was talking about the unintended consequences from the European central bankers implementing negative interest rate policy, or NIRP. And he basically said the unintended consequences in Europe are that not only has it made the pension fund crisis in Europe worse, but it also unexpectedly has really hurt European insurance companies. So the European insurance companies now, they might have bad counterparty risk, and they are not meeting their obligations. They need to assume a certain rate of return to cover their insurance payouts. They need to collect premium, and then they need to invest it. And if too many people try to collect the insurance money, then the insurance company is in trouble. So the insurance company has to collect premiums and then invest it. And if they can't invest it getting a good interest rate in bonds, then they're in trouble. And this is the problem with negative interest rate policy. So some of the banks with negative interest rate policy may have slightly gotten a little bit more money from depositors and fleece their depositors, but there's also problems with negative interest rate policy. And this is something that a lot of these dumb academics, many of whom have no real-world experience, who are not held to account with any of their screw-ups or bad theories over many-year career. Look at Larry Summers. The man has just fell forward with the Peter Principle. He's a book-smart guy, but the dude's been wrong on pretty much everything except for how to manipulate the gold price with Gibson's paradox for 30 years now, and yet he still gets more paid work. He still gets to write columns. He still gets consulting gigs. He's the president of freaking Harvard, for crying out loud, despite his track record of mess-ups. So this is the academia circle jerk. This is how Keynes became so prominent despite, never reading any real economics and all of Keynes' shortcomings. And Keynes was a scoundrel, too. There was a lot of really shady stuff. Whether Keynes was when he was working in the Bank of England and using inside information for currency speculation and other stuff. And also his shady, nefarious personal life, which I don't want to go into on this podcast because then I'll get demonetized. So just bankers being bankers. The funny thing, this is a conspiracy theory, but with how the Chinese do business, it wouldn't surprise me. The winning bid for the Warren Buffett charity lunch just was announced today, and it's from Justin Sun, who's Tron. He's a Bitcoin and blockchain entrepreneur, and he has Tron, and he's backed by Jack Ma and Alibaba. And so it would not surprise me. He paid almost $4.6 million for a lunch with Warren Buffett. So it's going to be funny seeing him discuss Bitcoin with Warren Buffett. We'll see if there's reports of them actually having a conversation about this. I honestly wonder, and this may be a conspiracy theory, but knowing how some of the Chinese do business, if there's actually going to be like an offer delivered to Warren Buffett about coming in and making a strategic investment into a Chinese bank. Like how Warren Buffett got preferred shares with dividends for AIG or Goldman Sachs. I would not be surprised if Warren Buffett got some type of sweetheart deal to inject billions of dollars in capital into some Chinese banks that no one else would get. And the Chinese would hope then that a large Warren Buffett investment would help bring in more foreign capital and American capital into the Chinese banking system, because they've been looking for ways to get dollars into the system. To get dollars into their banking system. There is a massive dollar shortage now in China, if you believe Kyle Bass. And I spoke to another portfolio manager who manages a lot of money, Austrian school economist as well. And he was telling me that most of China's reserves now are not liquid. They are used as collateral, according to his research. So he said China's reserves are down a lot, and that a lot of their reserves are being used as collateral at this point. They are not liquid. And a lot of it is spoken for a Belt Road Initiative as well. Okay, let me take a look at my notes. So I just wanted to bring the story. I have a couple stories on the second Chinese bank if you want to take a look, but things are starting to build. I would expect then, unless the Chinese, and it's really weird that the CCP actually allowed Reuters in China to report on Baoshang Bank in the first place. But I would expect now maybe the CCP to crack down and to stop any media announcements of any additional Chinese banks having problems. I'm surprised it even was allowed in the first place. So normally when things get this bad in China with any financial problems or any potential crisis, the media just cracks it down. The media shut down. So I have additional stories as well on some very interesting topics. This is from one of the best bank, hedge fund, and institutional bank analysts. His name's Christopher Whalen. He put the story out yesterday, and he actually put out how Fed policies are hurting bank earnings. So a year ago in the Institutional Risk Analyst, he predicted that net interest income for the U.S. banking industry would flatten out and decline around the first quarter of 2019. Sure enough, that is precisely what has happened. And then he says in his research, the cost of funds for U.S. banks continues to grow at 4 times the rate of interest income, suggesting that the net interest margin earned by banks may start to decline in 2019. Rising funding costs are being felt the most by smaller banks, driving the rate of change in interest expense over 70% year over year from 2017 to 2018. Quarterly funding costs for all U.S. banks should be close to $60 billion by the end of 2019 versus $37 billion in Q4 2018, a mere 62% rate of change as shown in the chart below. So this intervention by central banks, maybe it's helping out some of the larger banks that are more connected to the Fed, but the smaller and medium-sized banks are not benefiting from all this. And that's because they're not they're not voting members of the Fed. So the Fed is designed, it's owned by the large banks. So if you're a small and medium-sized bank, the system is also rigged against you. And there was a good book by John Allison that came out right after the 2008 financial crisis, and he ran BB&T. I believe he's a libertarian. He's one of the few banking CEOs that's a libertarian. You can go look it up on Amazon. It's an audiobook too. I read it. And he talks about basically that the Fed and other banking regulators, the FDIC and others, he said his bank was fine, had a great balance sheet, and did not need to take extra TARP money, and he said he was basically blackmailed and threatened to take the money. Because then if he didn't take TARP money, other people would assume that the other banks who did take the TARP money were in a lot worse shape than BB&T was. So he was basically blackmailed and threatened with criminal charges, being fired, all these things by regulators and the people in the U.S. government at the time, and the Treasury Department, and the Fed, and the banking regulators, that if he did not take massive amounts of TARP money, and he said he didn't need it, but he said, basically he took it because he didn't want to go to prison for his beliefs. Just crazy stuff. I'll look up the name of the book after the show. I can't remember it off the top of my head, but it's a really good read. It's an exciting read if you want to take a look. Okay, one more article on the banks. This one is from Washington Post. So we're starting to see domino effects in the European banking system. In China now, it's not quite as, the problems in China do not appear quite as big as Europe yet. The European Union appears a lot worse, especially with the stock charts, but we don't get a lot of the information about how bad things are in China. So maybe things are worse in China, but we're not going to get all that information. It's a lot easier to get information about how bad things are in Europe. Okay, so this article is actually about the American banks and a shadow banking system here in the U.S. So this article is from the Washington Post from a couple days ago, May 31st, by Stephen Perlstein. And his article is called "The Shadow Banks Are Back with Another Big Bad Credit Bubble." And he talks about how, of course, he's using unregulated and all this other stuff, blaming Republicans for the banks, because this is what the political hacks, the bias in the U.S. mainstream media, U.S. mainstream financial media does. And I'll talk about this probably in another show tomorrow. There was an article that came out last week that was blaming President Trump for bullying the Federal Reserve, acting as if President Trump was the only U.S. president in history to ever bully the Fed. I'm about to bitch slap that article writer. Okay, he's about to get put in his place for being a political hack and probably doing no research, probably getting paid $50,000 or more per year and cranking out a POS, a piece of shit article, in about an hour because it looked about 600 or 700 words. And I've been on deadlines before. I've worked in editorial, and I know how quickly, if you're a good writer, you can bullshit a one-page article, especially if you don't do any research and you're pretty good at writing. And that's about the quality of the bullshit that came out in this article. There was literally no historical research whatsoever showing that presidents from both political parties, whether it was President Richard Nixon or President Lyndon Baines Johnson or LBJ, bullied Federal Reserve. And I'll talk about that tomorrow. But, the spin on the anti-Trump, Trump derangement syndrome is just ridiculous. So, it looks like the new doomsday machine, after the mortgage-backed securities, the collateralized mortgage obligations, the credit default swaps, all that garbage. The new securitization process of leveraged loans is the CLO, the collateralized loan obligation, which promise high returns than low-yielding government and corporate bonds, and corporations gorged on leveraged loans to fund mergers and acquisitions, buy back their own shares, and pay special dividends to investors. So, and this talks about, after the 2008 crash, shadow bankers shifted their attention to business lending, using the same, quote, securitization process to buy and package leveraged loans, bank loans to big companies that were already highly indebted. So if you want to read more about that, I'll attach a link to that as well. Just crazy stuff. So basically, after, whether it was the Volcker Act or all the other legislation that the do-nothing, bankrupt, inept Congress, broken Congress, tried coming out with after the 2008 financial crisis and TARP and the bailouts, that the banks just figured out a new way around this, of course. Because that is the banker business model, right? Whether the bank is in Europe, the European Union, England, the United States, Australia, Canada, or China, the bank business model is, if you're a large bank especially, to maximize all profits, take every little penny possible, go pick up the quarters off the freeway in traffic. Well, actually not traffic, because if the cars are going faster, it's more dangerous. But go pick up the pennies in front of the steamroller or the quarters on the freeway, and then the part of the business model, while maximizing profit and paying yourself bonuses to take that risk, is expecting moral hazard, expecting that bailout, expecting the losses to be socialized. And this is pretty much uniform banker policy in pretty much every country at this point, unfortunately. And on top of this, we have the also with the junk bond debt, we had in the last 5 or 6 days, I think it was over the weekend, might have been on Thursday or Friday, TheStreet.com reported that there was another emergency meeting with Secretary of the Treasury, Steve Mnuchin, and other regulators talking about the credit markets, junk debt. So we have another emergency meeting here in the United States over junk bonds, over companies that have overborrowed. And hopefully I'll be able to get Danielle DiMartino Booth on for an interview soon. I've been speaking with her booking person again to get her. But apparently she spoke to insiders at the ratings agencies, and there is just tremendous pressure, like tremendous pressure. Threats of cutting back many millions of dollars in deals for the ratings agency to rubber stamp stuff, or firing an analyst if they're honest and have integrity, if they downgrade a company that has overborrowed, if they downgrade their credit rating. So this is the new normal. It's freaking weird. And on top of that, I just heard, I heard it last month from a longtime podcast listener. He gets extra money from Prosper and Lending Club. He loans out money to them. And what he said is that Prosper, I believe, sent out an email blast trying to calm down their lenders about a massive spike lately in defaults by borrowers. And even though some borrowers put down collateral, there's still massive defaults now in Prosper and Lending Club. So that's another bad sign that the real economy is getting a lot worse. Prosper is a private company, I believe. They're not on a publicly traded exchange, but Lending Club is on a publicly traded exchange. So just more banker shenanigans, right? Meet the new boss the same as the old boss. So I will attach all of these articles. I think there's 1, 2, 3, 4, 5. It's 5 articles if you want to take a look and go more in depth on this. But we do have another bank, and this one is larger than Baoshang Bank. So the people who are skeptical that Baoshang Bank was small, it was in Inner Mongolia, it didn't matter that the PBOC took it over about 10 days ago, almost 2 weeks ago, that it was insignificant, didn't matter. And I said, you know what? There's probably going to be another domino in the next couple weeks or couple months. And guess what? We have another one. So we'll see if the Chinese government actually allows for any news to get out about any more. Because now we have 2. And now people are starting to get worried. And I'm sure, and this is the most worrisome part, is that the banks now are starting to not trust each other. Because now that there's 2 banks, and it's a larger bank than Baoshang Bank, the Chinese banks, they're not going to trust lending money to each other. So what's probably going to have to happen is you're going to have to see some type of entity, maybe the People's Bank of China or some other regulator step in, maybe a state-owned enterprise bank, or a couple of these things, and start to guarantee things. Because this is what happened during and prior to the 2008 financial crisis with the LIBOR, with the commercial paper market, with the banks lending to each other. As things got worse and worse and worse in the U.S. financial banking and financial crisis in 2008, the banks stopped trusting each other. The counterparty risk exploded. The banks didn't trust each other. Even the big banks didn't trust each other. So we'll see if that happens to China. The European Union is bad. The European Union banks are really, really bad. And the stock charts for most of the European banks, even Societe Generale, which is normally considered one of the best European banks, but they have enormous counterparty risk. I'm sure that SocGen, which is a nickname for Societe Generale, I'm sure they have a lot of counterparty risk with Deutsche Bank or Commerzbank or banks that have counterparty risk to Deutsche Bank or Commerzbank. And this is the problem with the modern day fractional reserve digital debt-based currency banking system. Someone asked, when am I going to talk about money? I've talked about money for many years. It's in the channel archives. There's plenty of documentaries out about it. You can go to the Mises Institute YouTube channel. They talk about this relentlessly. I try to go to the global macro picture and how this is the reality in real time. Unfortunately, most libertarians and Austrian school economists do not understand the housing bubble in China, the banking system problems in China, the misallocations of capital in China. Peter Schiff is still repeating himself that China is going to decouple, that China's economy is better. He has no understanding of how much the debt, household debt, has exploded in China in the last couple decades, and small business and corporate debt. And if you don't believe me, go read China's Great Wall of Debt. It's a great book. Dispersing Weight says, crazy how Deutsche Bank is still greater than $5. There's been an enormous amount of manipulation. I talked about this last week on a live stream. There's been for some of the periods of manipulation in Deutsche Bank, it was a full year of manipulating the charts and trying to prevent a collapse. So massive amounts of manipulation. And then you saw the European Central Bank go to QE, and they weren't supposed to be able to do that. But the QE that the European Central Bank did, combined with negative interest rate policy, it looks like they've exacerbated the pension fund crisis even worse. And now on top of that, the European insurance companies are in big, big trouble. And so if the U.S. does this, if the U.S. goes to negative interest rate policy or NIRP, then the insurance companies would be, this is not financial advice, but the insurance companies in the U.S. would be good shorting opportunities, all of them then. Joni says no one trusts banks. So if you're a small business here in the United States, you may have to trust a bank. Unfortunately, you have to put down like your house as collateral. So you have to get a small business loan. There's a lot of unfortunate things that have to get done to get a loan from a bank nowadays, especially like a small business loan. The days in the past of the banks like giving out loans to a small business owner where there wasn't a personal loan guarantee and all this other nonsense is long gone. But the Chinese banking system, a lot of private companies in China cannot get loans from banks. And this is talked about in China's Great Wall of Debt. It's explained better. But basically, there's an enormous shadow banking system in China because a lot of private companies in China cannot get loans from the large state-owned enterprise banks. And so they would borrow money at normally a higher interest rate from shadow banking systems like peer-to-peer lending or other entities. And then once they started making some money from the loan, they would either pay back the loan or start putting money into a regular Chinese bank, a large one, and then they would buy wealth management products and start using that as collateral and leveraging that up. Exactly. So Jessel says to the guy who's asking about explaining money, The Hidden Secrets of Money is very good. The documentary, he spent tens of thousands of dollars on a couple animators for those 7 or 8 videos. So I highly recommend those. But there's a lot of books by the Austrian School of Economics, the Mises Institute, that are free, like Murray Rothbard, What Has Government Done to Our Money? That's a pretty quick read, and it's not advanced level Austrian School Economics. So What Has Government Done to Our Money is a very good beginner's Austrian School book. You can download the ebook for free on the Mises Institute website for that. And I think the audiobook, you may even be able to get the audiobook for free, or it's like $5 or something. It's pretty cheap from what I remember. Okay, well, I will attach the links to all this, to all these stories. Chris says AIG is a lame duck. Yeah, AIG, the more I research AIG, the more shadiness I found out. I saw the report from James Corbett about the founder of AIG, and it looks like he's from the deep state. The founder of AIG, one of the founders, or both of the founders of AIG are actually like former intelligence officers. So it has like a CIA, it has CIA roots, kind of like Facebook and Google. Herb says, Gunlock said, Switzerland insurance is going bankrupt, not if, but when. It won't be just Switzerland, Herb. It won't be just Switzerland. Because most of the European banking system is running negative interest rate policy. Which means then the insurance companies normally, I don't know all the laws in Europe for insurance companies, but here in the US, insurance companies are required for their reserves. They're required to reserve a lot of capital in liquid bonds. So normally like US Treasuries and other liquid bonds. And if they're not getting a good return on that, it's very, very bad for the insurance company. Okay, guys, well, that's it for this short little update. I will attach links to the stories. I'm going to go to the gym now, so everyone have a good rest of your week. But we have so many stories coming out lately. It looks like the next couple years are going to be very, very volatile, to say the least. And on top of that, you have emerging markets that are also a problem. So the dollar has stayed pretty strong. The commodities prices are not doing well. So the emerging markets are also having problems, and guess what? A lot of European banks have loans to emerging markets, whether it's emerging market governments, emerging market corporations, emerging market banks. So I would be, barring some type of coordinated intervention at this point, there's definitely going to be a crisis in the next 2 or 3 years, especially when we just had a second emergency meeting publicly announced from Secretary Steve Mnuchin. Either Mnuchin is really mishandling things and doesn't know what he's doing with being secret and handling these secret meetings and stuff, or he's leaking it out there because there was a party again last week that was about to fail somewhere in the junk bond market, maybe a bad counterparty or something, and he wanted it known that they were going to take care of them. So either one of those scenarios where Mnuchin doesn't know what he's doing, or they leaked it out intentional to calm down someone that was about to fail in the junk bond market, either one of those to me is very concerning. Okay, bye for now, everyone.